How y'all doing, good people? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers. So please be careful. Don't get yourself scammed. If you want to give me a follow on Instagram, guys, to kind of keep up with me when I'm not on YouTube, all you got to do is get down to the description box. Click on that Richard Fain Millionaire Mentor Instagram link and give me a follow. And then send me a DM to let me know that you're rocking with me. I certainly would appreciate that. Trying to get the Instagram page, trying to get the numbers up on it. So if you guys, like I said, if you want to know what I'm up to when I'm not on YouTube, then that's a perfect place to find out what I'm up to. So get down in the description box if you don't mind, and do me a big favor. Click on that Instagram link and give me a follow on Instagram. And like I said, send me a DM to let me know that you're rocking with me. I really would appreciate that. Need a little help from you guys on this one. Some of y'all know who've been following me for a while. I used to have another Instagram page. It was Richard Fain 28. That Instagram page was up to almost 90,000 followers. And we had a lot of fun on that Instagram page. I used to put out a lot of content because I had so many people following me there. It made sense to continue to put out the content. But for some reason, back in December of last year, Instagram decided to just take the page away, disabled it. Really didn't give me any reason why they disabled it. They just disabled it. So the only thing I could do was go ahead and create a new Instagram page, that's why you see the Richard Fain Millionaire Mentor Instagram page, the link down in the description box, because I know some people have asked me, what happened to the old page? Why you got rid of the old page? Well, I didn't get rid of it. Instagram disabled it. I mean, there wasn't nothing I could do. What do I fight? What am I sue them? I couldn't. You can't do nothing with Instagram. They just do whatever they want to do, right? You can't fight them. So I didn't. I decided not to try to fight them, and I just said, something? I'll just create a new page. And right now that page has about 3,400 followers. So I appreciate all of y'all who have signed up for the Instagram, not signed up, but followed me on Instagram. It ain't nothing to sign up for, but if you're on Instagram and you're on there following other people, and I'm in your gang of 5, why wouldn't you follow me? That's the way I look at it. If I'm in your gang of 5, give me a follow just like the rest of these folks you follow, right? And I'm gonna be on the financial end, and then with a little lifestyle thrown in there. So if you're interested in that, give me a follow. Next thing is the website, Richard Fain Millionaire Mentor website. It's been up about a month. Over 100,000 of you guys have already went over there and checked out the website. And I want to say thank you, because a lot of you guys have made an investment in yourself and grabbed some of those digital products that I got to assist you in getting to your pot of gold at the end of the rainbow. Everything from credit restoration, credit repair, how to increase your credit score, all the way to how to invest in the stock market through index funds. Also how to use the drip investment strategy when you're buying paper assets, reinvesting your dividends for compounded growth over a long period. All of that stuff is on the website. All of it is in the form of digital products that I personally handpicked and put together to help you get to your pot of gold at the end of the rainbow. So here's the deal, guys. I can't be on YouTube 24 hours a day, 7 days a week, live, right? Now my videos, I got 1,100 videos up there, but that could be intimidating for some folks. To try to find exactly what they're looking for in those 1,100 videos it can be intimidating. So what I decided to do, because you guys asked for it, I created a website. And in that website, you got these 10 digital products that basically sum up the 1,100 videos that I got on YouTube. That's basically what it does. I've taken those 1,100 videos and I packaged them into these 10 digital products that cover everything I cover on the YouTube channel. right? What do I cover? Real estate investing for income. I got a digital product on the website for that. Matter of fact, I got a couple of them. Stock market, digital products on the website to help you learn about the stock market, start investing. And then I got businesses, how to start an online business, how to scale an existing business. And then I got credit repair, credit restoration, increased credit score. I cover that on the YouTube channel. Side hustles, I cover that. I also cover millionaire mindset, right? Reprogramming your filter system. That's on the website. So 1,100 videos, I've condensed them into 10 digital products. So if you don't have the time to go look at all 1,100 videos, which if you got the time, do it. But if you don't, go to the website and there you go, www.richardfain.net. It's the second link down in the description box. Go check out those digital products. And for those of you who want to take it to the next level, join my mentorship club. There's a little bit of yellow box that says membership. When you go into the website, you can't miss it. If you're on your phone, just scroll up if you're using the phone, the mobile phone. But if you're on a laptop or a desktop, as soon as you get there, you'll see it in the top right. But if you're on the phone, you got to scroll up a little bit and then you'll see it. It'll say membership. If you want to become if you want me to mentor you along with a private group of other individuals that are part of my mentorship club, right now it's about 350 of us. And I'm gonna cap it real soon though, because I don't want it to get too big. So if you want to be in the mentorship club, hey man, get over to the website and sign up, right? It's a monthly subscription to be a part of that. Why? Because my time is valuable. I already spend a lot of time on the YouTube channel for free to give out information. But if you want me to be your personal mentor, I can't do that for free. That's my time. That's my time. My time has a value associated with it. And the 300 plus people who have already signed up understand that. My time has a value associated with it. So if I'm a personally be mentoring you, answering your questions and doing these 90-minute live streams, private live streams that I do every Monday at 8 p.m. Eastern time for 90 minutes for my mentorship club. I gotta, you know what I'm saying? The stuff that I do on YouTube is free, right? You just open up your phone, go to my YouTube channel. You got 1,100 videos right there to watch. The thing that a lot of people, some people get intimidated by is, now you got to be able to execute on those 1,100 videos on your own. But in the mentorship club, you got me to help you execute on them. That's the difference. So if you don't need me to help you execute, you don't need to join. You just stay watching the videos and there you go. You're going to get this every day. You can take that information, throw out what you don't need, keep what you need and execute. Then you don't need to be mentored by me. You're good to go. But for those of you that need some extra, the mentorship club is where you get the extra, right? So consider that, like I said, second link down in the description box for the website. Let's move on. Last thing before we get into these meat and potatoes, because we got a lot to cover today. We got a lot going on this week. We got a lot of wealth building opportunity that's getting ready to happen this week, but we got to position ourselves in order to be able to take advantage of it. And that's what I'm going to be giving you today. But before we get to that, let me talk about Moomoo, which is my self-directed brokerage app that I use. That's my primary brokerage app that I use to double the net worth over the next 10 years, buying 3 big boy paper assets. SPLG, which is my S&P 500 ETF, FTEC, which is my information technology ETF, and then of course you guys know, the big boys, the Magnificent 7 stocks. Those are my 3 big boy investments I'm gonna be buying month after month, year after year for the next 10 years, and I'm gonna be using the Moomoo app to do it. If you want to rock with me and emulate what I'm doing, copy my plan, and you are looking for a good self-directed brokerage app, or if you just want an extra brokerage app, maybe you got an app that you're using, or maybe you got a brokerage account that you do a lot of your retirement stuff in, but you're looking for something to get in and start doing some stuff in a taxable brokerage account. That's where the Moomoo account will come in to help you out, right? I got 4 brokerage accounts, but the Moomoo account is my primary brokerage account that I'm going to be using over the next 10 years to double the net worth. Now, if you click on my link, which is the first link down in the description box, for a limited time, you're going to get yourself 10 free fractional shares of the Magnificent 7 stocks. That's not going to last forever, guys. That's a limited time offer that Moo is doing for folks that rock with me. They click on my link down in my description box and sign up. When you put $100 in your new brokerage account, you don't give me the $100, you don't give it to Moo. It's your $100, but it's a qualifier. Once you qualify by putting your $100 in, they gave you the 10 free fractional shares of the Magnificent 7. So stocks. So if you want to rock with me and you want that opportunity, get down in the description box, click on that Moo link, go get that free stock, go get that free money. Well, let's dive into these meat and potatoes, man, because we got a lot to cover. And we're going to start with a $10 billion real estate fund that's in trouble. And it will rock the real estate market if it fails. It's in trouble. So we got to talk about that and connect the dots to why that's important to you and me. Why is it important if this $10 billion real estate fund crashes? Because here's what you got to understand, guys. If a $10 billion real estate fund is in trouble, how many more are in trouble? That's what you got to ask yourself. See, this is not an isolated situation. I've already told you guys months ago, there were about $1 trillion in commercial real estate debt maturing. What that means is their interest rate is ending. They got to reset that interest rate. The problem is when those loans were taken out, interest rates were cheap. They were low. Now interest rates are super, super, super high. So these loans that were at a 3%, 3.5%, 4% interest rate, guess what they're going to reset to? 7, 7.5, 8. I told y'all my baby sister just took out a loan for a commercial loan to buy a piece of real estate for her business. 8.25 was her interest rate. See, a lot of y'all get confused with housing market, primary residence. Yeah, those interest rates are maybe 6.75, 7.25. That's for a primary residence. That's residential. But on the commercial side, those rates are higher. They're higher than on the residential side. So yeah, 8.25, 8.5 is probably the going rate on the commercial side. And a lot of these big, gigantic funds, like the one we're going to talk about today, are in trouble. They're in a liquidity crunch. And I'll tell you what that means in a second. So let's dive in. Let's dive into that. And then we're going to get ourselves into what can save them. We're going to talk about how the Fed can help save them. And then we're going to talk about the stock market and the opportunity that we have this week to really, really, really transfer some wealth. If we're laser focused, if we're dialed in, if we have a financial game plan for this week ready, we'll capitalize. We're going to talk about that here in a minute as well. So let's dive into this dark cloud that's over the commercial real estate market. And I'm telling you guys, I know some of y'all are saying to yourself, oh, I don't know nothing about commercial real estate. That ain't got nothing to do with me. Guys, yes, it does. We're going to connect the dots. You do not want a $10 billion real estate fund to fail. It's a rippling effect through our economy. I don't care where you're at. It's going to affect you. It's $10 billion fund, guys. So let's talk about it. Here's the headline. 10 billion real estate fund faces cash drain and limited options. Fancy word for what? They're running out of cash and they really got no options. Refinance ain't an option because rates are too high. Can't sell anything because rates are too high. Who gonna buy it? You're stuck between a rock and a hard place, but let's get into it. A significant commercial real estate fund managed by Starwood Capital Group finds itself in the throes of a pressing financial quandary, triggered by a surge in investment demand for the return of their capital. So here's what happens, guys. Let me just break it down for you real quick. These funds are set up People invest in these funds, put their money in, right? These real estate funds. Some of them are called real estate investment trusts, right? Or REITs. They put their money in these funds. The thing is when people want their money back, they want it back. Now, there are some safeguards that these funds put in to kind of, make sure people can't just all at one time. But the problem with this fund is people are wanting their money. They're wanting to get the money out of the fund. They don't have the money. But let's keep moving. The mammoth 10 billion fund under the stewardship of Starwood Capital Group is presently grappling with a cash crunch of considerable proportion. The fund has been fervently endeavoring to safeguard its available cash and credit by imposing constraints on investor redemptions. This is what happens, though, when you have interest rates through the roof. This is what happens with these types of funds. People go to panicking a little bit. People want their money. They want to diversify. They want to do different things. But these folks don't have the cash because they done went and spent the cash on more real estate, management costs, operating costs, whatever they spend this money on, right? They don't have the cash. And that's a problem. They don't have the cash. However, despite these efforts, the fund faced a staggering $1.3 billion in withdrawal requests during the initial quarter alone. So you got people coming in there asking for $1.3 billion just in the first quarter. It's only a $10 billion fund. People are asking for $1.3 billion. Give me my money. I need my money. Problem is they don't have it. That's the problem. That's another problem in itself. You're a fund that big, but you don't have the cash to honor redemptions. Something's wrong. Something's wrong. Something don't smell right. Something got a bad smell to it inside of this fund, guys. That's why I keep telling y'all, you better know where you're putting your money. You better know where you're putting your money. Something don't smell right. We're going to get to the bottom of it here in a second, or at least we're going to try to. So here we go. However, despite these efforts, the fund faced a staggering $1.3 billion in withdrawal requests during the initial quarter alone, managing to satisfy less than half of this amount as per regulatory disclosures. I told y'all earlier, these guys, they build safeguards in these funds where they say, hey, we ain't got to honor your redemption, or we only have to honor so much. So you better read the fine print, guys, before you stick in your money. Oh, somebody told me this real estate investment trust was going to give me a 5% return on my money. Okay, you better read that fine print. You better read the fine print. Read the fine print. Regulatory disclosures, that's what fine print is called. They don't have to do nothing if it's in that fine print that says they don't have to do it. So they didn't have to honor the 1.3 trillion. They only had to honor, they said what? About half of it. So half of the people who requested money got it. What did the other half do? Stuck like Chuck. The other half stuck like Chuck. You can't get your money out. And this thing could be going down like the Titanic and you won't even know it. Can't get your money out till it's too late. Till it's too late. Can't get your money out, right? Managing to satisfy less than half of this amount per regulatory disclosures. Despite implementing measures to curtail investor redemptions, the fund's liquidity, inclusive of cash reserves, marketable securities, and a line of credit from a financial institution, has been rapidly depleting. So these people, when you look at the balance sheet, they got line of credit financing from a bank. Right? They got marketable securities. They got cash reserves, and they're ripping through all of them. At some point, the bank who has the line of credit is going to come with their hand out and say, can't let you tap on the line no more, guys. Your net worth is out of covenant compliance. Well, what is covenant compliance? That's right. That's what banks do. See, when banks lend you money, they have certain requirements that you got to meet. And if you don't, you'll find yourself in default. These people are going to they're probably in a position right now, whoever their lender is for that line of credit, they're probably telling them, we're freezing the line, no more withdrawals on the line, no more revolving until you get this matter under control. That's probably what's happening. They're probably having to sell the market. The problem with the marketable securities is they may not be in a positive position on those securities right now. They may be in a negative position. That's the worst time to sell them. So you got a line of credit that you may or may not be able to use, depending upon what the lender is saying right now. You may have marketable securities that you're underwater in right now. So that leaves your cash reserves, which are quickly and rapidly depleting. Not looking good, guys. The liquidity pool, which stood at a robust $2.2 billion by the close of 2022, saw a significant erosion, plummeting to a mere $752 million by the end of April this year. So you go from 2.2 trillion in liquidity, guys, to 752 million. That's a problem somewhere in that organization. There's a problem. There's a management problem. Whatever they're investing this money in, maybe these investments went sideways. Who knows? But there's a problem. There's no way you should go from 2.2 billion in liquidity all the way down to 752 million by the end of April. Subsequently, exacerbating the fund's precarious financial predicament. All these big words. Y'all know they got all these little big words in here, but you get my drift. That's why I'm breaking it down for you in just so simplest terms, right? Basically, these people had 2.2 billion in liquidity, and they've blown through most of it. They've blown through what? 1.5 billion. They've blown through. Where it went, I don't know. They in trouble. So my point is this: if they're in trouble, there are probably others that are coming. I told y'all guys, there's a $1 trillion bogey, a $1 trillion bogey coming due. 24 and 25. It's just starting to raise its head right now. This is the first one now. This is the first domino. The first domino that could fall is right here in the 5th month of 2024. You got the first domino of many more to fall. Be careful. Be careful where you got your money. You better know where your money is. You better know where your broker, your money manager, or whoever the world you got managing your money, you better know where these people got your money at. Please know. Please find out today what's going on with your money. Where is your money at? Because ain't nobody gonna knock on your door and say, hey, yeah, you know, this $10 billion real estate fund is going out of business, so we better go ahead and take your money out. They can't get your money out. They already told you they got no liquidity. They can't get your money out. They can't even get your money out. So be careful. Be careful. Here we go. Here we go. The Starwood Real Estate Income Trust, as a consequence, finds itself confronted with 3 inevitable options, none of which offer an appealing solution. The fund could opt to incur additional debt. Now they're telling you what this fund can do to try to put a plug in that big old hole that's sinking the Titanic. They're trying to walk you through the options they have to try to save the Titanic because it's taking on water fast. They're trying to save the Titanic. These are the 3 options. Here's the 3 options. They could opt to incur additional debt. Here's the problem with that. Interest rates are so high, man. Plus, what lender is going to walk in and want to finance them who want to take a cruise on the Titanic when it's sinking? Ain't nobody want to take the Titanic when it's sinking. I don't know how valuable that or viable that option is, but let's keep reading. the fund could opt to incur additional debt, potentially exacerbating its financial burden given prevailing high interest rates. See, here's the thing, guys, with interest rates. This is what the Fed has been trying to do for 24 months. This right here. This is what 24 months of high interest rates do to the market at some point. Something breaks. Why? These interest rates so high, it's hard for these guys to either borrow money or sell stuff because whoever's buying it from them probably ain't paying cash. They're going to have to go get a loan. And guess what? Nobody wants to take on an 8.5% loan. High interest rates probably will prevent them from getting more debt. Alternatively, it could navigate the challenging market terrain by divesting properties. All that fancy terminology and all that those fancy words mean they could sell some of their assets. Here's the question though, and this is what you got to think about. When there's blood in the water, who shows up? When there's blood in the water, who shows up? Sharks. See, when there's blood in the water like this, guys, this is the real world we live in, and this is big boy business. This is big boy business right here. This ain't us. This ain't you and me putting our $100 in the Moomoo account and trying to build wealth over a period. This big boy territory right here. They don't care nothing about you. When there's blood in the water like this, ain't nobody gonna pay you market value for your assets. They're just not gonna do it because they know there's blood in the water. They know you on the Titanic. You got a big old hole in the side of your hull and you're taking on water like crazy. They know it. There's blood in the water. Here come the sharks. Here come the sharks swimming. Blood in the water. Ain't nobody gonna give you market value for your assets, baby. It's just not gonna do it. They're not gonna give you market value. You gotta take under market. You gotta sell your assets below what they're worth. Just saying. However, the current market conditions characterized by depressed property values. See, I just told y'all that. See, I done been through this, guys. I was in a commercial banker for 25 years. I done been through this. I done seen companies like this. I don't know what's going to happen to them if they don't get a real capital injection and really right the ship. See, and the problem with capital injection is it's just some management problems going on. If you blow through $1.5 billion of your reserves and you still in trouble, something going on in the management, upper management, senior man, somewhere, somebody doing something wrong. So what investor is going to want to come in and put their money into the Titanic? And it's sinking. It's tough. However, the current market condition characterized by depressed property values present formidable obstacles to this approach. That's true. No one's going to give you market value, right? They're not. They're going to give you under market value. They're going to lowball you. They're going to want it for 50 cents on the dollar. That's the way it is because blood's in the water, right? What's the third option for them? Here's the third option. Lastly, the fund could contemplate halting or curbing further redemptions. Basically, we ain't giving y'all nothing. You just gonna wait. Read the fine print. We ain't giving you nothing. We stop all redemptions. You better know where you're putting your money at. I'm just telling you guys, whoever you're trusting, you better know who you're trusting and you better know where they're putting your money at. Right? Lastly, third option, the fund could contemplate halting or curbing further redemptions, a measure that would severely impede its ability to attract new investors and could potentially precipitate all these, what are you people with all these words, man? Oh, this is ridiculous. A measure that could severely impede its ability to attract new investments and could potentially precipitate a deeper financial crisis, right? So all that means is when you halt redemptions, when you refuse to give people their money when they ask for it, guess what that tells new investors? Stay away. Stay away. That's what it tells a new investor, right? If I'm a new investor looking at this fund and I see where they won't honor redemption requests, you think I'm putting my money in there? I probably not, right? So that's all three of those options are viable options, but I don't think they get anywhere with any of them. They definitely ain't gonna get away with new people coming in. They're not gonna do that. Nobody's gonna put their money in if you won't honor redemptions, right? They're not gonna get that. I don't see where they get money for a loan because interest rates are too high, and I don't think any bank will finance them when they're in this type of trouble, right? Now, what they could do is they could liquidate and get rid of some assets, but they're gonna get rid of them at a discount. And me and you, guys like me and you, gals and guys, we can be on the recipient side of these discounts. That's why I talk about all the time, guys. It's not bad when we see things like this, not if we're trying to build wealth, because there's a potential to get discounts. It's a potential to go in and get very good assets at a discount, and then you hold those very good assets till they trade at a premium again. History tells us they will. So anybody that's going in to buy anything from these folks, I'm talking about the big boys, they're going in to buy any assets, they're going to get them for cheap as they can get them. Why? Because they can. They got the leverage. These people have no leverage. They're the Titanic. They ain't got but minutes before the whole ship is underwater. They have no leverage. The people coming in to look at these assets to purchase have all the leverage. They got all the leverage. They have no leverage. Just like with you and me. See, when we have money to invest and we got all of our financial house in order, we have all the leverage. I have the leverage because I can go out and buy any asset I want. I have the leverage, right? So this week, I got all the leverage. I can take my money and go shopping. I can go shopping this week and pick up discounts. I can go shopping this week. See, when I got money and I got income and I have my financial house in order, I have all the leverage. Nobody can stop me because I have all the leverage. If I go out to the residential real estate market and I find a house today that I like, and that house been on the market for 12 months, who got the leverage? Me or the seller? I got the leverage. Your house been on the market for 12 months, buddy. You have no leverage. No one will buy it. That's why it's been sitting here for 12 months. You don't have no leverage. I have the leverage. But the only reason I have leverage is because I got cash. I got income. I got low debts or no debts. I got no high credit card interest rate debt. I'm not paying a $700-800 a month car payment. I'm not spending half of my take-home income on a house that makes no money. No, I ain't got none of that stuff. I got cash and I'm ready to go. So I have all the leverage. That's what's going to happen to these folks. That's what's going to happen to these folks. So here we go. Lastly, the fund could contemplate halting or curbing further redemptions, a measure that could severely impede its ability to attract new investments and could potentially precipitate a deeper financial crisis. Should the fund refrain from decisive action, that means making a decision and move forward. That's all decisive is. You ain't wishy-washy on the fence, flip-flopping. No, you make a decision, you move forward. That's decisiveness, right? So what they're saying right here is, should the fund refrain from decisive action? That means if they just sit there and just don't do nothing, don't have a cohesive plan. That's what refrain means, right? If they refrain from being decisive, if they flip-flop around and don't make a decision here soon, here's what's going to happen. It faces the grim prospect of exhausting its cash and credit reserves before the accumulation of the fiscal year. Yeah, man, I told y'all. It's the Titanic. They don't have but minutes before that thing full up with water. They're saying right here, if they don't get a plan together and take action, don't I tell y'all that all the time? What I told y'all. You want to sit around here and flip-flop and make excuses, don't get a plan together, don't do nothing. Guess what? You're going to be just like the Titanic, filling up with water. Before you know it, you're going to be underwater, gone for the rest of the days. So what do you got to do? You got to get a plan and be decisive. I keep telling y'all, sign up for Moomoo, get your brokerage account, put your $100 in it. Just do that every month and just keep stepping it up. See, that's a plan and that's being decisive. All of this, oh golly, I gotta know more. I need more info. Send me this, send me that. I can't do this, I can't do that. I gotta have this, I gotta have that. That's not decisiveness, guys. That's not how millionaires become millionaires, is because they're indecisive. They become millionaires because they're decisive. Who cares if you make a mistake? So what? Learn from it, keep going. I don't know why all of a sudden, we need to be perfect investors. We ain't been perfect in no other part of our life. Well, all of a sudden now I got to be perfect. You ain't been perfect this long. I haven't been perfect. I make a lot of mistakes, still do. 56 years old, still make a lot of mistakes. But I don't let that stop me. I don't let my fear of making mistakes stop me from getting to that pot of gold at the end of the rainbow. I'm getting mine. I don't care how many mistakes I make. If I ain't making no mistakes, something wrong. That's the way I look at it. If I'm not making mistakes, something is wrong. Something wrong in this picture right here. I can tell you that right now. I'm no genius when it comes to these big companies like this, but I can tell you right now, if you go from $2.2 billion in reserves down to $752 million, something wrong. And you did that within a year and a half? Something wrong. If I'm over here living paycheck to paycheck, high interest rate credit card debt, $800-900 a month car loan, got zero in my retirement account, got no emergency fund, something's wrong. Somebody in here hear me today. Somebody hear me in here, I know. Somebody understand what I'm talking about here. So y'all think I be talking about this stuff just to be talking about it, but it parallels our financial life. We're no different than this company. We are no different than this company if you're listening to me today. Something's wrong with this company. I don't care if they're a $10 billion company. That's what I keep telling y'all, guys. I don't care how much money you make. It's what you keep and multiply. They're a $10 billion company and about to go out of business. Doesn't matter how much they make. It's what you keep. $10 billion company. They got $752 million in reserves now, and that is going quick. I don't care how much you make. It's what you keep and multiply is what matters. Let's keep reading. Let's keep reading because it ain't over yet. They are not out of the woods yet. They are not out of the woods yet. While other real estate funds grapple with similar pressure stemming from heightened redemption requests, the largest fund in the domain, Blackstone Real Estate Income Trust, has managed to maintain a formidable liquidity position of $7.5 billion, successfully fulfilling all redemption requests earlier in the year. Nevertheless, the continued trend of withdrawals surpassing new capital inflows remains a pervasive challenge across the sector. So what they're telling y'all is, yeah, the 900-pound gorilla Blackstone is doing fine. That's what they're telling you. But everybody ain't Blackstone. I would go to say majority of them are not Blackstone. The majority of them are just like Starwood. Across that industry, they're struggling. Why? Why are they struggling? Because they got more outflows than inflows. Well, Richard, what does that mean? That means you got more investors running for the gate, running for the door, than you got investors trying to come in the door. You got more investors running out of the door. Give me my money, than investors coming in the door saying, take my money, take my money. That's the problem. And that's across the market. Why is that across the market? Because right now, with these types of firms, they thrive when interest rates are low, guys. That's when they thrive the best. When interest rates are high, they can't buy assets cheap enough to make sense. They can't, the financing cost is too much. Plus, when they're not making money, guess what happens? What happens to the return on your investment? it goes down. Why in the world will I keep my money in your RIT and I'm getting 2% when I can just take my money out of your RIT and go put it in a money market and get 4%? That's the problem they're running into. And that's all directed at what? Interest rates. See, in this business right here, interest rates are extremely important. I'm not going to keep my money in this real estate investment trust if I'm only going to get a 2% return on my money. If I'm getting a 1% return on my money, I could just put it in the money market. So people are doing what? Give me my money. Give me my money. I'll be back when times are better. But right now I need my money. So the outflows are larger than the inflows. These companies only can operate if they have more inflows than outflows. And yeah, Blackstone might be doing okay right now, but who knows what trouble they're in? We don't really know, right? We don't really know. But they said right here, nevertheless, the continued trend of withdrawals surpassing capital inflows remain a pervasive challenge across the sector. Now, how does that affect you and me? Same way. If our outflow is greater than our inflow, what does that tell me about my financial situation? Anybody in the chat? Anybody in the chat walk me through, if my outflow is greater than my inflow, what does that do to me financially? Not good, guys. Not good. That means you're living on more than what you make. Just like these guys. $10 billion company. Got more leaving out the door than coming in the door. I don't care how much money you make, guys. It all gets down to what? How much I got coming in versus how much I got going out. It all comes down to that. I don't care if you're a little guy like me and you or a big old giant like this company right here. It's how much do I have coming in versus how much going out. That's it. So big company, small company like you and me, we our own little company, right? Then you got this big old gigantic company. They got more going out the door than they got coming in the door. They can't survive long that way. Same with you and me. If I got more going out the door than coming in the door, I'm not going to survive. I'm not going to survive. Now, what are my options? Just like this company. I got the same options. I got the same options as this company. What are my options? I can try to go to the bank and borrow money to kick the can down the road. I can try to go to the bank. I can try to go to the bank and borrow money to kick the can down the road. The problem is when you go into a bank and they know your outflow is greater than your inflow, what's the likelihood they're going to give you a loan? It ain't good. I don't know no bank in America going to give you any money if they know you can't repay them. Just not going to do it, guys. They're not going to do it. So your option is just like their option. They can't borrow money. You can't borrow money if your outflow greater than your inflow. What's the next option? The next option is what? Sell off my assets. Just like this company. I have to sell these assets. I got to sell whatever I can sell. And I tell you guys that all the time. When people come to me and talk about this and that and this and that, and the first thing I'm going to say to them is make a list of all the things you have that have value that are not essential to life. Well, what do you mean? I mean, everything. Your purse collection, your Michael Jordan tennis shoe collection, your extra cars, your house, your Pokemon card collection, your Star Wars collection, whatever you got. If it got value, sell it. None of that crap is essential to life. None of it. You take that cash and you pay off this debt. That's what you got to do. But see, here's the thing. 95% of people, they're not willing to do that. Why? Because see, their worth is tied to the things that they own. Their self-worth is tied to this car or this house or this Gucci handbag or whatever this superficial make-believe materialistic stuff they've wrapped their life into. That's what they believe brings them value. So they won't sell it. What's the third option for me? The third option for me is to do what? Just not pay anybody. I know I owe the credit card people, but I ain't paying them. I know I owe that car loan, but I ain't paying them. They're going to have to find me and repossess that thing. I ain't going to even keep it at home no more. I'm going to just park it down the street. They got to find me. That's the third option. The third option is you just don't pay people. That's what this company's third option was. Halt redemptions. Just don't pay nobody. Don't honor any redemptions. On my side, it's just don't pay people. Don't pay the credit card company. Don't pay the car loan company or bank. Don't pay my rent. Don't pay the mortgage. But yet and still, I'm still going out to dinner. Now, I ain't paying the mortgage. I ain't paying the car people. I ain't paying the credit card people. But I'm still going out to dinner. I'm still going out partying. I'm still traveling. I'm still flossing on Instagram. I'm still flossing on Facebook. But yet and still, I ain't paid nobody. I ain't paid none of my obligations, but I'm still flossing. I know some of y'all know what I'm talking about. I know somebody here in this chat understand what I'm saying today. I know a lot of y'all missing it, but I know somebody understand because you're saying to yourself, yeah, that sounds like exactly what I'm doing. So I keep telling y'all guys, these companies are a micro, they're a bigger, so you got micro and macro. They're a bigger macro of our society. They're a macro, we're a micro, right? So that's what we got here. We got a big old gigantic company who is going down like the Titanic, and they're looking for some type of relief. They're looking for some type of direction. They're looking for this direction. So Starwood emerged as one of the most prominent real estate funds launched during the period spanning 2017 to 2022. Second in size only to Brett, or Bright, B-R-E-I-T. Yo, I ain't good with all these, whatever that is. These non-traded real estate investment trusts, REITs, or REITs, garnered substantial investor interest, particularly during a period categorized by low interest rates. I just told y'all guys, these REITs, they thrive in low interest rate environments. When these interest rates are too high for too long, at some point it catch up to them. And that's what you're starting to see happen. That's why I keep telling y'all, and we're going to get into something here in a second about the Fed. They got to reduce rates, guys. This is just a tip of the iceberg that's coming. It's 1 trillion of these things out here. $1 trillion in real estate, commercial real estate that's coming due in 24 and 25. This is the tip of the iceberg. Tip of the iceberg. And something like this, guys, if it fails, it will send catastrophic tidal wave through the real estate market, through the housing market, through the stock market, through the crypto market, and through our economy. I promise you. I promise you. So somebody got to bail it out. Who gonna bail them out? Probably the United States government. Probably. That's who gonna bail them out, probably. Somebody gonna bail them out. It gotta be. And normally it's the United States government that steps in and bails out companies of this size. Because the magnitude of the people who will be devastated by this. Some people got their life savings in this thing. Some people got their life savings in this thing. Just saying, man. Just saying. Be a good steward of where your money is invested. I tell people all the time, listen, man, if you're not comfortable investing your own money for yourself, fine. But whoever you get to invest your money, you better know what these people putting your money in. And some of y'all, I've gotten emails from y'all where, hey, yeah, I've called my broker. They don't call me back. Yeah, I called my broker. They don't really tell me they don't really answer my question. I'm just like, I'm saying to myself, who in the world let somebody manage their money and they won't call them back? You ask them to send you information, they just don't. I mean, who keeps their money under management with somebody like that? See, this is the thing that I can't quite wrap my head around. Why would you keep your money with somebody or some firm that don't return your phone calls, don't give you the explanation? Why? Why? Because we're afraid. We're afraid to take on that responsibility of our own. We love giving responsibility to somebody else for us. So we got somebody to blame if it go wrong. See, we want to have somebody to blame if it go wrong. We don't want to point the finger at us. Y'all know I ain't telling no lie. We don't want to point the finger at us. So we going to point the finger at them. Nope, it wasn't my fault. It was XYZ brokerage company. It was their fault. It was all their fault. No, it wasn't. You're the client. You're the boss. They work for you. You should know what they got your money in. If you don't like what they got it in, tell them to take it out and put it in something else. You the boss. And if they don't want to do it, fire them. But we don't want to do that in a lot of cases because we want to blame somebody else. We don't want to look at us and blame us for nothing. It makes us easier for us to go to sleep at night. We don't want to blame ourselves. We want to stay blameless. No, wasn't my fault. My fault. It was that guy's fault. That's what we like to do. Better get ourselves out of that, guys. Here we go. Let's finish this, and then we're gonna get out of here and go take a look at the Fed. These non-traded real estate investment trusts, these REITs, garner substantial investor interest, particularly during a period characterized by low interest rates, offering attractive dividend yields in the range of 5%. See, that's how they trick you. That's how they trap you. And I'm not saying anything wrong with that. You just got to know when to know, right? Can't consistently give you a 5% dividend if they ain't making no money. They can't do it. They can't do it long term. If they're not making money in a high interest rate environment, there's no way these guys be able to keep up that 5% dividend. However, a paradigm shift occurred as interest rates surged. See what I tell you? See, I told you. So I tell you, I be telling y'all this before I even read what's going on because I already know. I done seen this before. See, in a high interest rate environment like this, these real estate companies, it's hard for them to make money. It's hard. And pay you 5% when they got to pay 7.5%, 8.5% for the debt. It's hard. It's hard to make any money. It's hard to break even. Right? And then as that dividend starts coming down, guess what people start doing? Give me my money. Give me my money. Give me my money. I ain't getting the 5% no more. Y'all ain't got to pay it, but give me my money. Because they got a right to cut the dividend whenever they want to. But I also got a right to get my money out of there whenever I want to. At least I thought I did. But you've got to read the fine print, right? So that's what happens. However, a paradigm shift occurred as interest rates surged and commercial real estate values experienced a downturn. Why did commercial real estate values have a downturn? Why, guys? Here's why. I'm going to give you a really quick one. Here's why they values downturn. Because of income. See, unlike residential housing, guys. See, residential housing is based on what? What someone's willing to pay you. It's what the market is willing to pay you. It's based on, typically, it's based on location. It's based on people's desire to live in that location. It's based on comps in that location, right? What they sold for, what somebody willing to pay them for it. That's mostly how residential real estate is the value is derived at. It's different for commercial real estate. See, in commercial real estate, since it's not a primary residence, it's an investment, it's an income producing property. The really thing that really values one of these types of properties is the income it generates. Different for a single family home that I live in, doesn't generate any income. So they can't base the value on income for a residential property in most cases, right? They value it on people's desire to live in that area. What they're willing to pay to live in that area. It ain't really about the house, it's about the area. Different for commercial, right? They're looking at income. Income drives the value for commercial real estate. So here's how values start dipping in commercial real estate. Two ways. Number one way is the debt that you borrow to buy that property, the cost of that debt increases. What do you mean, Richard? Well, when I bought this property 4 years ago, the bank gave me a 4.25% interest rate for 5 years. Let's say I bought it 5 years ago. They gave me a 4.25% interest rate 5 years ago. That's what I'm locked in at for 5 years. That's what my cash flow is based on. Now, all of a sudden, you fast forward 5 years, 2024, that interest rate is over. I got to reset that interest rate, but I can't reset it at 4.25 because those rates don't exist anymore. I got to reset it at 8.25. That 4% increase in interest on a $2 million, $3 million, $4 million, $5 million, $10 million, $12 million, $15 million loan is a lot. So what does that do? It cuts into your cash flow because your original cash flow was based on 4.25 interest rate. Now your cash flow is based on an 8.5% interest rate or 8.25 interest rate. Your cash flow just went down. Now here's the second thing that gets you. Let's say over that 5-year period, initially you had 100% occupancy. Every unit was filled with somebody operating their business, doing great, doing well. Boom, pandemic hits. Country shuts down. Guess what your tenants say? I can't work, Richard. Can't pay your rent. So I'm going to work from home. I'm going to work from home. I don't need your building no more. I can't. Country shut down. I can't pay you no rent. So what could I do? Nothing. I got the country shut down. I can't do nothing. I'm getting no rental income now. I'm getting no rental income, right? So then all of a sudden the pandemic goes by. People start kind of coming back. The problem is not all 100% of them came back. Maybe only 75% of my pre-pandemic tenants came back after the pandemic. I got 75% occupancy now. Originally, I had 100. My cash flow was based on 100%. Now I got 75. So not only did my interest go up by 4%, but my occupancy went down by 25%. That's where people get into trouble. Now the property, when it was originally valued, it had 100% occupancy, it had a 4.25 interest rate, you had more income, which equated to what? Higher value of the property. Fast forward 5 years, you got a higher interest rate, lower occupancy, the property's income is less, so the value is less. That's how you get into trouble. And that's what's happening here. That's what's happening all across commercial real estate landscape, right there. That's how you get into trouble. So here's the thing. However, a paradigm shift occurred. Interest rates surged. Commercial real estate values experienced a downturn, prompting investors to reassess their positions and triggering a significant exodus from these funds. Bingo. That's where the outflow comes from. Because what happens is when that interest rate goes up to 8.25 and that occupancy goes down to 75%, you got less income. You can't afford to pay that 5% dividend anymore. As soon as I can't pay that 5% dividend anymore, guess what my investors start saying? I got to get out of here. This is what I'm living on. I'm living on this 5%. This is how I take care of myself. You've cut the dividend to 2.5%. I can't take that. I'd rather take my money and put it in my money market where I get 4%. That's what's happening all across the landscape. In response to this evolving market dynamics, Starwood and its counterparts commenced imposing restrictions on redemption requests, limiting them to as low as 2% of their net asset values monthly and up to 5% quarterly. However, the influx of new capital markedly diminished, a trend exacerbated by heightening scrutiny from analysts and financial advisors regarding the efficacy of the fund's structure. Starwood monthly new fundraising plummeted from over $600 million in the first half of 2022 to a mere $15 million. You go from $600 million inflow to $15 million. Come on, guys. Somebody help me out here. Somebody help me out here. You go from over $600 million in first half of 22 inflow to a mere $15 million, reflecting waning investor confidence amidst the prevailing market headwinds. The fate of Starwood, and indeed the broader real estate fund landscape, hangs in the balance as it grapples with the formidable challenges posed by redemption pressures and constrained fundraising capabilities. Starwood Capital Group finds itself at a critical juncture, contemplating a myriad of whatever that word is, options in a bid to navigate the treacherous waters of the commercial real estate market. I ain't gonna even read the rest. Enough. The point is this: write your financial ship today, or you're gonna be like Starwood here. You're gonna be like Starwood, but on a smaller scale, but just as big to you. You better write the ship today, guys. You better figure out what you need to do to get your financial house in order, or you're gonna be like Starwood. You're gonna be like Starwood. You're gonna all, listen, if you got more outflow than inflow, you better sit down today and figure out why. If you got more outflow than inflow, you shouldn't be going out to eat. You shouldn't be taking no vacations, no trips. You shouldn't be going to no barbershop. You shouldn't be going to no beauty salon. You shouldn't be going to no nail salon. You shouldn't go to no pedicure. You shouldn't be doing no mall. You shouldn't be doing any of that if you got more outflows than inflows. You shouldn't be doing any of that. None. What you should be doing is taking an inventory of all this crap that you've accumulated over the years and sell every piece of it. Take that cash, whatever high interest rate credit card debt you have, pay it off. If you got a car loan that you're paying more than 10% of your take-home income for, sell it. You should be paying no more than 10% of your net take-home monthly for a car payment. That includes looping in the insurance and the gas. So if I'm paying more than 10% for my car payment, my insurance, and my gas, sell it. And find you something that you could be under that 10%. So if I'm making $5,000 a month take home, I should have no more than a $500 a month car payment. Matter of fact, in my opinion, you shouldn't have no car payment. Sell it, go get you an A to B, a reliable $2,500, $5,000, $7,500 A to B, and be done with it. This is not the time to try to keep up with the Joneses, guys. For a lot of us, this is our last hurrah. This is our last hurrah to get to gold, to get to that pot of gold. This is the last opportunity we got for a lot of us. So you can waste it if you want to, trying to keep up with the Joneses, trying to worry about what people think because you had to downgrade your car, trying to worry about what people think because you got to downgrade the house, trying to worry about what people think because you had to sell the Michael Jordan tennis shoe collection. You care more about putting a California closet in your house than getting the freedom. Oh, I need a California closet because all my buddies got it. All my neighbors got it. I got to have a California closet. I can remember I bought this house right here, came in the house, and the guy that was selling it to me, the contractor, we go in the back room, right? I'm looking in the back room, I'm like, hey man, why ain't no shelves in the primary bedroom? I got both big old closets in there. I got no shelving in the primary bedrooms. He says, well, we don't put any in there because most people that buy houses like this, they go get, decked out California closet and all that stuff. I said, I won't be one of those guys. So whatever the free shelving y'all put in here, put it in here. He said, okay. No, give me what it's free. I ain't putting no money in no California closet. California closet already rich. So I need a California closet to hang up my clothes. No, that's just pride. I didn't need no California closet. No. Give me what's free. See, but we want to be all in the closet with the camera and showing Facebook and on Instagram how we paid $10,000 for California closets. I mean, are you out your mind, man? You think I'm going to pay these people $10,000? No, that ain't happening. Give me the free stuff. I can take my $10,000 and put it into S&P 500 ETF for the next 10 years and double it. What do I want to get at the California closets for? See what I'm saying? But this is what I'm talking about. So what do? Sit down today. If you got more outflow than inflow, put a plan together. The plan should consist of making an inventory of everything in your life that's materialistic, that is not essential to living. Sell every bit of it. Sell it all. Facebook Marketplace, eBay, Craigslist, wherever. Sell it. Take the cash. Take a look at your debts. If you got credit card debt, pay that off first. If you got a car loan that exceeds 10% of your take-home pay, sell it. And then keep going down the list. Once you right-size all of that, your next step is what? Open your brokerage account. If you want to, the Moomoo account down below. Click on that Moomoo link, open it up, put you some money in it. They're going to give you 10 free fractional shares of the 10 free fractional shares of the Magnificent 7 stocks. Then from there, the money that you saved from paying off this debt, now you got more inflow than you got outflow. Because why? You sold all of this materialistic stuff and paid off the debt. You sold all of the materialistic stuff, took the cash, paid off the debt. So now you should have more inflow than outflow. Let's say my inflow is $5,000 a month. Let's say my outflow is $4,000 a month. Now I have $1,000 a month since I paid off all of this debt, all of these credit cards. I got $1,000 a month that I can start investing in assets to build wealth. That's a simple game plan, guys. Let's not make it more complicated than. Well, Richard, what do you mean? What do you mean $1,000? What do I got to put it in? How long I got to put it in? When can I take it out? That's the next question, right? Because we got no patience. That's why along this journey, you got to reprogram yourself. I know you've been taught impatience. I know you've been undisciplined. I know you lack consistency. How do you know that, Richard? Because I lacked all of that stuff when I was 26. I had none of it. Very impatient, no discipline, no consistency. Very impatient. But I had to learn all of those things. And I'm glad I did. It humbled me and it got me on the pathway to wealth. I've given you the blueprint, what you need to do. So I don't want nobody emailing me saying nothing about what do I do. That I just told you what to do. Now, whether you do it or not, that's on you. I told you what to do. If you want to get out of this mess you in financially, I already told you what to do. And it's free. I just gave it to you for free. Told you exactly what to do. Problem is, most people don't want to do what it takes. They'll try to rationalize it. Well, this car, I know I'm paying $750 a month for it, but you know something, for the work I do, I gotta have an image. I gotta have a certain image for the work I do. I am a doctor. I am a lawyer. I am a business owner. I have to keep I can't show up in a used car. See, this is the crap we do to rationalize to stay broke. Why? Because that's how we programmed. See, we programmed to think we need these fancy cars because someone really cares, which they don't. Not really. No one cares. Matter of fact, they're probably envious of you. Matter of fact, they probably don't even like you because of that. Just telling you the truth, guys. So what you got to do is right size yourself so that you're not this company. So you're not this company. There's very, very little light at the end of the tunnel for this company. I can tell you that right now. Very little light. They're going to probably be investors in this company that are going to not be made whole. I don't know that for a fact. I'm just telling you what my summation is just by reading through this, man. This is not good. This is not good. But this mirrors a lot of our financial life. This company is a direct mirror to our financial life. A lot of y'all ain't gonna make it unless you change something today. A lot of y'all ain't gonna make it. And I just gave you the blueprint to get yourself right side. So hopefully some of y'all listen to that blueprint. Let's get into a little bit. What time we got here? How long I'm in this thing? Okay, I got a little bit. I got a little bit of time. I ain't gonna hold you long. Bear with me. I ain't gonna hold you long. Bear with me. We want to talk a little bit about the Fed. Just a quick 5 or 10 minutes on the Fed. Then we're going to hit the stock market and some opportunities. Then we're going to get out of here. So lock it in with a thumbs up, guys, if you don't mind. I got a lot of people in the chat. Lock it in with a thumbs up. I appreciate all y'all stopping in here and checking on your boy. Appreciate you. Appreciate you. Lock it in with a thumbs up. We got a couple more things to connect the dots, and then we're going to get out of here. Couple more things to connect the dots. Couple more things to connect the dots. Why, here's the headline, why Jay Powell really wants to lower interest rates this September. So let me connect the dots for you. We just talked about the trouble that's brewing in the commercial real estate market that will spill over into every other market if we're not careful. We just talked about the biggest thing that can happen for the commercial real estate market is what? Interest rates go down. That's the best thing can happen to that part of our economy. That part of our financial market is interest rates go down. How does that play into the Fed? Because they control interest rates. See, we're going to connect the dots. So the Fed has a role to play in what happens in this economy, guys, because they see the trouble brewing over here in the commercial real estate market. They can help. They can help this commercial real estate market. They can help this housing market by doing what? Lowering interest rates. So let's talk about the potential for that happening here in September. Markets rallied to new record highs last week, and the Dow crossed 40,000 level for the first time in 139-year history. Anybody was on the live stream yesterday, I talked about the Dow a little bit. You're talking about 40,000 points, guys. The highest it's ever been in 139-year existence. Right? After inflation cooled, that means the April CPI inflation report was cooler than expected. It didn't come in hot this time like it did the first 3 months of the year. It came in cooler. It came in lower. That was good news. Coupled with the April jobs report came in weaker than expected. Those two pieces of information is what's fueling this stock market run right now. It brought back FOMO. It brought back enthusiasm to the tune of 40,000 points in the history of the Dow. 139-year history. Never did it before. But here's what's coming. Here's what's coming. Here's what's coming. The Dow crossed the 40,000 level for the first time in 139-year history after inflation cooled for the first time in months, stoking hopes that the Federal Reserve could start cutting interest rates as soon as September. Very, very, very needed. We just connected the dot from interest rates to the commercial real estate market. We connected that dot. That's what they need to survive. If anything to help Starwood, this $10 billion real estate fund survive, it's lowering interest rates. That will help it survive, right? And the Fed has the ability to do that. But will they? That's the question. Fed officials tamped down some of the excitement during a full state of public appearance where they repeated that inflation was still too high for their liking. So will the central bank lower interest rates or not this fall? That's the billion-dollar question. That's what Starwood, this real estate investment trust, $10 billion real estate investment trust is asking. That's what they're asking. Fed, are you going to throw us a lifeline? Will you throw us a lifeline? We don't know yet, but let's keep reading. It's interesting to me that the equity market is cheering the idea that the Fed is going to be cutting rates. If the equity market, who's the equity market? Anybody in the chat can tell me who the equity market is. Who's the equity market? That's companies, right? That's companies. That's the equities market. That's companies. Stocks, ETFs, index funds, mutual funds, right? That's the equities market. The equities market is cheering them on. Why? Because when interest rates go down, equities go up, right? Assets go up, paper assets go up, right? So they're cheering them on. If the equity market is cheering the fact that the Fed is going to extend the current economic cycle by cutting rates a couple of times, I would agree with that. I just think we have to be careful. There tends to be a fine line between cutting rates and extending the economic cycle, or cutting rates because the cycle is to an end. What does he mean by that? Well, there's a fine line that if you cut rates, maybe it stimulates the economy, right? If you cut rates, maybe it doesn't stimulate the economy. Maybe that ends the cycle. Maybe if they lower rates, the stock market, the boom ends. But if they lower rates, it could continue. That's the fine line you got to walk, he's saying. If we cut rates, it could end the cycle right now. If you don't cut rates, right? So we got to be careful. Here's a fine line, right? He's saying we got to watch out for. There tends to be a fine line between cutting rates and extending the economic cycle, or cutting rates because the cycle is coming to an end and the economy is softening. Now, you got people on both sides of that, though. You got some people saying the economy is softening and we're going to go into a recession. Ever heard of a guy by the name of Jamie Dimon, CEO of the largest bank in America, JP Chase? He's one of those guys. If we're not careful, he's saying we're going to run ourselves into a recession here, guys. He's saying that, and along with some other really smart people. But then on the other side, you got people like me I'm an optimist. I think cutting rates is going to send us to the moon, send us to the sun, send us to another galaxy. That's what I believe. So you got people on both sides of that equation, right? I can tell you what Starwood is saying right now, this $10 billion real estate company. I can tell you what they're saying. Cut rates. We need it. We need a lifeline. Please cut rates. That's what they're saying right now, right? That's what they're saying. All investors are really going to have to grapple with that in the coming months. Our view is that you start cutting now and you actually can extend the cycle. See, that's the way I feel. Cut now, extend the cycle, because you already got the optimism, you already got the FOMO, right? I think you got the FOMO, you got the optimism. Cut now and extend the cycle. That's what I say. But we'll see what the Fed is going to do. We'll see what the Fed is going to do. What do you mean exactly by extending the cycle? Let's talk about it. When the Fed is cutting rates, it's cutting rates because a recession is about to happen, right? Technically, that's when they cut rates. They cut rates. Think about the pandemic. Think about the pandemic. They cut rates all the way to dang on near zero. Matter of fact, they did cut them to zero. Why did they cut rates to zero? To stimulate the economy. How do you stimulate the economy? You introduce a new supply of money to the economy. That's how you stimulate it. How do you introduce a new supply of money? You cut rates so that they're so low, it's dirt cheap to borrow money. And then you take that dirt cheap money and you buy other assets that give you a higher return than the dirt cheap money. That's how you stimulate the economy. People will also borrow money to buy things. That stimulates the economy when people are buying things. They're consumers. That's why reducing rates typically mean we're in a recession or we're headed to a recession, and you do that to counteract the recession by stimulating the economy, right? So when the Fed is cutting rates, it's cutting rates because a recession is about to happen, right? That happens almost every single time where the Fed is cutting and recession is upon us. That's why I say there's a fine line between the Fed cutting to extend the cycle and the Fed cutting because a recession is about to happen. You really are threading a needle here. The Fed has been in a precarious space where they're trying to avoid a recession by lowering interest rates. How have they done in shaping a narrative around that. I think you have to go back to last July. We were at 4.2 from a core inflation perspective. That's more than double the target, which is 2%. But the Fed decided that they were done with the hiking cycle. So when you hear about the dovish pivot that happened in December, it didn't happen in December. It actually happened in July, which is true. So what these people are saying here, guys, is, the Fed has a job to play in this all. They control interest rates, right? If the Fed decides that they're going to reduce interest rates twice this year, and they start in September, I think that continues the cycle. That continues to rally everything, right? I think it also will save a lot of companies in the commercial real estate space. I think it will help prop up and get the housing market started going again. Now, I'm not worried about my house losing value. What I'm worried about in the housing market is the thousands and tens of thousands and hundreds of thousands and millions of people that work in the housing market who are not making any money right now because there are no housing transactions taking place. That's what I'm more worried about. I'm not worried about my house losing value. It's a big part of our economy where millions of Americans who take care of themselves through the housing market. And right now, with interest rates so high, it has brought down demand. So when demand comes down, home sales go down, which takes food off of people's table. That's what the Fed can do to help with that, right? That's what they can do to help with that. Question is, will they do it? We'll have to see, right? I think you've gotten some data in the month of May from April that supports it. The question is when we get to June and we look at the May data, will it support it? I think if you get a good solid report in May and you already got the solid reports in April, no question. I think in September they reduce. I think they got to. Plus, I think they're going to have pressure from the White House. No sitting president wants to go into an election with an economy that's sideways. He's just an easy target to get picked off. No sitting president wants to go into an election cycle when the economy is not doing well and people are scared that they're going to lose their job. People are scared that they're not going to be able to take care of their families. No sitting president wants to go into an election with that over his head. So I promise you, the Fed is getting some feedback from the White House as we speak. And I don't believe they have any choice but reduce rates in September. I don't care what happens. They're going to reduce these rates in September before that election. Before that November election, they're going to reduce these rates. I just think they're going to get so much pressure from the White House, they got no other choice. That's my opinion. You guys may disagree, but that's my opinion. All right, let's move on to the stock market, and then we're going to get up out of here. Look at some opportunities here, and then we're going to get up out of here. But I wanted to connect the dots for you, right? The dots are what? You got this real estate thing that's happening. It's driven by interest rates. You got the body, the Federal Reserve, who controls interest rates. They could remedy that. They could save a lot of people's money and heartache, right? So there's the dots. That's how you connect the dots, right? How does that reflect you and me? We're no different than Starwood, some of us. We got outflows greater than our inflow. I've told you what you need to do to correct that. It's a pretty simple process. Let's not mess it up. Let's not complicate it. Let's be decisive. Let's sell all this crap that we don't need, pay off our debt, and now we got more inflow than we got outflow. Now we can start investing to build wealth. Period. What do you invest in? We're going to talk about that right here in the stock market, right? Here we go. Stock futures are flat as Dow tries to add to rally above 40,000. That's the headline. U.S. stock futures. And what is that? That means before the stock market opens, they got these predictions. That's what I call it. I mean, I'm no expert here, but I call it predictions. So the stock market opens at 9:30, right? But you got these predictions before it opens. I call that the futures. That's what the futures market is, right? It's all these predictions that what the stock market is going to open at, what the Dow will open at, what the S&P will open at, what the Nas will open at, what stocks will jump, what stocks won't jump. That's what the futures is in my little world I live in. I'm no expert, so if you want to go get somebody else's opinion that so-called is an expert, go out there and do it. I'm just giving you my little poor man's version of what it is, right? U.S. stock futures were little changed on Monday after the Dow closed above a key 40,000 level for the first time last week. And I mentioned 139-year history. It never did that. Well, what's going on then? I shouldn't be investing. Yeah, you should. You think it's going to stay there? You think it'll never go past 40? Come on, guys. I told y'all in 10 years it could be 55, 60. Who knows? I'm going to know because I'm going to be in the market 365 every single year until 10 years. Right? I got 10 more years in the stock market. Futures tied to the 30 stock index traded near the flat line, which means really no change. S&P futures and NASDAQ 100 futures were higher at 0.1%. So the NASDAQ and the S&P in the futures came out ahead of the Dow, right? The Dow was flatlined. They were up 0.1%. The Dow hit the 40,000 level during Thursday's trading session, but posted its first close over the threshold a day later when it added 134 points or 0.3 and ended Friday at 40,359. This market rally should continue at least in the short term. Again, this is coming from some expert, right? Head of research at FundStat Global Advisors. He's saying it should continue in the short term. As we stated earlier this month, we expected markets to shift from fear of May to buy in May. Where did the fear come from? April. The fear came from April. That's when the FOMO left, and that's when the optimism left the market in April. But then May rolls around and you get these two incredible pieces of data, and what happens? What happens? Buy mentality came back. Fear mentality was in April. Buy mentality came back in May because of that data, that incredible data we got, that CPI inflation report, that jobs report, right? As each week has passed, this has been the case. Looking into next week, we expect this to continue, he wrote in an email. So he's saying he sees that continued buy into this week. He sees that, right? This is just one expert. You don't have to agree with it, but I'm just giving you some backdrop to what we're going to discuss here real quick before we end. Artificial intelligence names are due to steal the spotlight this coming week. Y'all know where I'm going with that, right? Who am I talking about? What AI name is going to steal the spotlight this week? Somebody in the chat, let me know. Which AI company is going to steal the spotlight this week? Bingo, Nvidia. Why? They have their first quarter, fiscal year first quarter earnings report coming out on Wednesday. And guys, this is going to be a big one. It's going to be a big one. Here we go. Investors will be keeping a close eye on Nvidia's fiscal first quarter results due Wednesday afternoon to gauge the strength of the AI-led rally. Now, here's the thing, guys, and this is where I'm coming to. And again, I'm not your financial advisor. I'm not trying to tell you what to do. I'm just telling you, let me paint this picture for you. For 3 quarters in a row, Nvidia has hit a home run on the earnings report. 3 quarters in a row. Their stock price has went from the hundreds in 2022, to over $974 a share in March of 2024. low 100s or 100s. So I'm in the 100s in 22 to 974, closes at 974 on March 25, 2024. Coming up with its first quarter fiscal year earnings report. If they hit a home run, that will be 4 quarters in a row. Who is the leader in the AI space right now? Nvidia. So it makes sense if they hit a home run on Wednesday, what's going to happen to the AI-led rally? The rally continues. So what should I do, Richard Fain, to position myself if I believe they hit the home run? I got to be in the game. I got to put myself in the game right now. Okay, let's take a peek here. Let's take a peek and see what my favorite individual stock company is doing right now, because I'm trying to position myself right. I'm not trying to time the market. I'm just trying to take advantage of a monster that's finna get ready to double in size over the next several years, right? I'm trying to figure out, what do I do with this monster? This monster right now is up $19 a share already. It's at a 943.85 right now. Your boy believes it goes to well over $1,100 a share if they hit a home run on Wednesday. That's what I believe. I certainly believe I capture at least $100 a share. So my plan is to get down, get in where I fit in. And that's all I'm gonna say about that. I'm not your financial advisor. I'm not trying to tell you what to do. I'm just telling you what I'm doing. You got to do what you got to do. But I'm telling you what I'm doing today. Right? Here we go. Here we go. So that's coming. Nvidia is coming. Nvidia's shares have gained more than 1% Monday before the bell even opened, before the bell. Already went up 1% in pre-market, right? Bullish analyst calls, which highlighted the company's preeminent market position, several Wall Street firms have also increased their price target on the chip maker ahead of its earnings report, suggesting shares could gain as much as 30% their current levels. Okay, let's go back to this. Here we go. Here we go now. Here we go. What's 30% of 943? Times 30%. So they're saying right now, here's what they're saying. The experts now, some of your big boys, I'm talking about your big boys, Goldman Sachs, big boys. They're saying 30% on top of what it's trading at right now. So if it's trading at 943 right now, that means an additional $282 a share if they hit the home run on Wednesday. So that means the stock goes to $1,225 a share. Okay, that's it. I'm done, because I don't want nobody accusing me of you know what I'm saying? Let me tell you something, guys. If that happens, Lord Jesus, woo! The stock is up nearly 86% in 2024 alone. And it is almost 196% higher over the last 12 months. That's it. That's it for me. I ain't read no more of that. I'm done. That's it. That's it. I'm gonna drop the mic on that one. Drop the mic on that one. You do whatever you got to do. You do whatever you got to do, but I know what I got to do. And when I do, I'm telling y'all something. On Thursday morning, in this live stream on Thursday morning, all right. Appreciate y'all, man. Again, do me a big favor. Get down to that description box. Click on that Moomoo link. Open up that new Moo account today. I just ran y'all through one of the magnificent 7 stocks, which is Nvidia. It's getting ready to do big boy things on Wednesday. Just my opinion. Just my opinion. Not trying to give you financial advice. I think they're going to do big boy things on Wednesday. If you want the opportunity to have a fractional share of this giant, this behemoth, you got to get down to the description box and click on that Moo link. You got to open up your Moo account today. You got to fund that thing, and you got to position yourself and be ready to go. You ever seen NASA when they start that countdown? When they start that countdown for that thing to go to the moon? You ever seen NASA when they start that countdown for that spaceship to go to outer space? You know how they start that countdown? Countdown is started. 48 hours. 48 hours before blast off. It is 48 hours before lift off. The question is, are you going to be on the ship? Are you going to be on the spaceship? Are you going to be on the spaceship, buckled in, going on this joyous ride, or are you going to be down on the ground as a spectator taking pictures when you could have been on the rocket ship? Or are you going to be down here taking pictures? Oh, golly, ooh, what a nice rocket ship. Wish I could have been on it. No, but that's on you. Get down to that description box, click on that Moo link. Let's get it going. You got 48 hours, man. You got 48 hours to position yourself. I don't know how fast you can get money in your brokerage account, but you got 48 hours to position yourself. You got 48 hours. Because I promise you, on Thursday morning at 10:30 a.m. Eastern time, when I come on this live stream, I'm going to tell you the results. But you got 48 hours. That's it. What are you going to do? Barbecue or mildew? It's up to you, man. Get down in the description box, click on that Moo link, get yourself positioned. Also, get over to the website, www.richardfain.net. Get over to the website, man. Get in where you fit in, man. Get you some of them digital products. Get your mindset right. I keep telling y'all, more outflow than inflow, no bueno. No bueno. More outflow than inflow, no bueno. You need more inflow than outflow. The products that I have on my website will get you to a position where you have more inflow than outflow. But again, man, you got to put yourself in the game. You got to get on the rocket ship. Can't nobody force you to get on the rocket ship. You can stay down here on Earth and watch the rocket ship, or you can get on the rocket ship. That's up to you. But when you go brush your teeth at night and you're looking in that mirror, guess who you blame if you ain't on the rocket ship? You. Blame you. Because you got 48 hours to get on the rocket ship. Whether you get on or not, that's on you. All right, man. Appreciate y'all. Make sure, hey, last thing. Hey, we're going to have a live stream tonight. We're going to have a live stream at 8 o'clock p.m. Eastern time tonight through my mentorship club. It's a private live stream. Nobody who ain't part of the mentorship group ain't going to get into it. You can't get into it. You got to be a part of the mentorship group. Got to be a part of that. And a portion of that time, I'm going to talk about this opportunity. I'm not trying to convince nobody because y'all know my channel is not a convince you channel. It's not a convince you channel. It's an opinion channel. Hey, man, it could go the other direction, but I'm okay with that. See, I'm a big boy. I'm decisive. I don't worry about that. See, I'm a big boy. If I make the decision, I live with the consequences. That's what big boys do. That's what big girls do. Big boys and big girls live with the consequences. We learn from them, but we live with them. There's nothing perfect in this world. Ain't nobody gonna give you nothing. So tonight, 8:30 p.m. Eastern time, I'm gonna be on my live stream with my membership club, and we're gonna talk about this opportunity, and I'm gonna answer their questions to the best of my ability. If you want to be a part of that live stream, man, that small group of individuals who've decided to make a big investment in themselves, then be a part of it. You can be a part of it. All you got to do is go to the website, click on That membership link, it's a yellow button, click on it, and then sign up, right? Sign up. And again, it's paid. It's a paid membership, guys. I'm not trying to hide from that. It's a paid membership. My time is valuable, just like your time is valuable, right? I know what value I bring to the marketplace. So I'm going to get compensated for the value I bring to the marketplace. You could decide that it's not value to you and just stay on the free stuff on the YouTube channel. You can do that. Or you can come join us tonight. All I do is get down on the net and get you some digital products and sign up for the membership club. Because tonight, we're going to get into that membership club and we're going to talk about this opportunity. And I'm going to tell folks exactly, because I'm pulling the trigger today. It's done. And I'm going to tell the folks exactly what the trigger I pulled. And again, I'm not telling them that for them to go do it. They don't have to do nothing. I'm just telling them because that's the transparency that I did rock with to my mentees. So I'm gonna tell them exactly what I did, what I pulled the trigger on, because I believe what I believe. So be a part of that, man. If you want to, get over to the website and become part of the membership group, right? Well, all right, man. Appreciate y'all. Lock it in with a thumbs up before you get out of here. Y'all know I appreciate y'all for rocking with me, man. It's been real. I got a 2 o'clock one-on-one session with a gentleman, 2 o'clock one-on-one. Y'all know I still do the one-on-one sessions through my company, RF Financial Consulting, where you spend 1 hour with me on the phone and we talk about your financial situation. I give you some guidance, some direction, and then boom, you go execute. So I still offer those sessions, and I got one at 2 o'clock today, and then tonight at 8 o'clock Eastern time, we got the 90-minute private live stream where we're going to be talking about all things wealth building. So I'm a busy guy, man. You know, live streams during the day, edited video this afternoon, one-on-one this afternoon, then another hour and a half, 2 hours tonight. This is what I do, man. This is how I get down. This is my calling. This is my purpose. I love it. This is what I do all day, guys. I get my exercise in the morning. I eat. I try to eat right. Definitely get the exercise in. And keep my mind positive. And I keep helping people all day long because I know if I help enough people get what they want, I ultimately get what I want. That's it, man. That's it. So if you want to rock with that, get down to the description box and rock with them links. Rock with me and rock with them links, right? Also, Instagram. Give me a follow on Instagram, guys. This is my last pitch for Instagram. Give me a follow on Instagram. Down in the description box, Richard Fain Millionaire Mentor Instagram page. Give me a follow on Instagram if you don't mind. I really would appreciate that. Trying to get my new Instagram page where my old one was. Maybe I never get there. I had 90,000 people on the old one before it got shut down. This one, I'm up to about 3,400 people. So I want to get this thing to 5,000 by the end of May. So do me a favor, if you're an Instagrammer, you do stuff on Instagram, give me a follow. And then send me a DM to let me know you're rocking with me so I can say thank you. Plus, somebody just in the chat just reminded me of this, and I definitely want to say thank y'all for this. We just got the YouTube channel over 700,000 subscribers, guys. You're talking about from 2020 to 2024, first four or 5 months of 2024, we got this thing up to 700,000 subscribers. And I owe that all to you guys. So thank you so much for blessing me. Thank you for blessing me. Y'all come back every day to hear me. And I know sometimes, you know, hey, I'm just a human being, right? I'm just a human being. I'm flawed just like all of y'all, right? I'm flawed. But one thing I can tell you, 700,000, I owe it all to you guys. So thank you. Thank you for rocking with me. Thank you. Let's get this thing on over 1 million. I don't know. Let's do it. Let's get this thing over 1 million, right? I think we can do it. So let's go to that level. Let's take that thing to the 1 million level. Let's get that gold plaque. We already got the little gray plaque, but let's get that gold plaque when you get to 1 million subscribers. I believe we can do it. I'm going to be on here for the next 10 years, so I'm liable to do it at some point. Because I'm going to be on here for the next 10 years grinding, right? I'm going to be on here the next 10 years grinding. Well, okay, man, I'm out of here. Appreciate y'all. Lock it in with a thumbs up before you get out of here. Thoughts become things. You can see it in your mind. You can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy, right? Get wealthy. and I'm gonna catch you guys on the next one.